Thank you, Mike. And once again, it's easy to be the chairman when you have such a great team, I think, that is fully capable of putting on so many interesting sessions and as Mike said, teaming up to turn 4 office floors into 4 conference centers with the best views in the world of any conference center. Unfortunately, we're in Salesforce space. They've started to fill up the floors, and we'll be filling these floors up, so we'll have to find a new location next year. Hopefully, if you have one with views similar to this, we would love to try to entertain that. So this afternoon on our final panel, we're going to focus on capital markets and the importance of capital markets around the world. Cannot be overstated in so many ways, and the developments in them. And I've, over the years, my little formula I wrote down at Berkeley in 1965 really tried to stress the importance of capital markets and the fact that access to capital played such an important role to serve as a multiplier effect on the world's largest assets, human capital and social capital. And with that, I'd like to turn first to Rich Byrne. Rich formerly was one of the senior executives at Deutsche Bank. And Rich, there's a great deal of discussion today about regulations, particularly of the banking system around the world, Rich. And I'd like you to maybe reflect, if you still had your position in charge of North America for Deutsche Bank and financing today, and how that might have reduced your flexibility, and then give us a look from your current view as a manager of financial assets and how some of these changes might be positive in your current position.
Well, thanks for that question, Mike. It's a pleasure to be here. Some extraordinary things happened as a result of the crisis on the banking side. Banks were forced in many ways to go against the rhetoric of what they were supposed to do and sort of needed to manage themselves within a financial regulatory regime that was much different. I'll give you a couple of examples. Number one, maybe a good one that was a result of regulation. It's that classic pendulums here, it swings grossly to the other side, was managing effectively hedge funds within banks. This was always a very big business. It got bigger and bigger and bigger over the years. And certainly, I don't think anybody would disagree that that's probably not the profile for our big money institutions to be in.
And often that might have been called prop desk.
Yeah. And I think most of that capital sort of found its home in the form of hedge funds. And that's a disintermediation that probably made a lot of sense. But I'll give you some examples of 2 that maybe were less obvious that have led to cottage industries, of course, the asset management world, including for ourselves. One example is a real estate conduit. Banks were some of the biggest lenders to the CMBS world. And if you looked at a league table from 2007 and a league table to today, I'll give a little advertisement for a few other firms. You know, it's no longer JP Morgan, Deutsche Bank, Bank of America, Wells Fargo. It's, you know, maybe some of those names with volumes, a fraction of what they were then. It's Ladder Financial, Cantor Fitzgerald Real Estate. It's that type of stuff. And let me mention another business that's very near and dear to our hearts is direct lending, middle market lending. I mentioned that there were consequences that are almost the opposite of political rhetoric. So political rhetoric is getting banks to lend to small companies, right? That's what's going to invigorate the economy. Well, I will tell you at Deutsche Bank, this was one of our most vital businesses that we had across the bank. It was great ROE. You could lend to smaller companies. If you really know how to do your homework, you can get incremental yield, custom make your covenants. It was a great business. Well, guess what happened? After 2008, regulation came. We were managing to Basel II, 2.5 at the time. And then all of a sudden, the risk-weighted assets just didn't make any sense whatsoever to be in a business where you were effectively treating that business with the same risk profile, let's say as a single B bond or loan, as almost the equivalent of equity capital. And before I end that point, let me say another thing about that. This was caught in between sort of 2 regulatory regimes of how we had to run the business, because banks at the same time no longer had these prop desks and all these other businesses as their revenue drivers are sort of regulated out of those things. So what's the other lever banks can pull when times are tough? Costs. What are the bank's costs? If you added up all the costs combined in a bank, none of them equals even a fraction of the cost of the people. What goes, as they say, up and down the elevator every day. So it really became an exercise, sadly, for folks like myself, to pare down our costs in every way conceivable, but certainly people costs are one obvious. Well, you know, it takes as many people to underwrite a $50, $100 million loan to a little $50 million EBITDA company as it takes to do a $30 billion LBO sometimes. So again, what gets caught in the mix is a business that, you know, very sensible, good for the economy, all those things, but you know, an unintended consequence of regulation, like in the other examples I gave, was a business that passed from banks, to your question, Mike, to the disintermediators, to some of these alternative capital providers. In our case, that's a business that we're in.
Right, so in your new role at Benefit Street Partners, part of Providence Equity, essentially you're able today to take advantage and fill the role that you used to be able to do at Deutsche Bank. Is that correct? Pretty much, that's right. Our team at Benefit Street largely consists of the very same people that have done this either at the bank or in some other institutions. The void that was created by the banks leaving this space has been disintermediated. Who is it disintermediated by? It's lenders like ourselves, private lenders with funds, either senior lenders, the GEs of the world, down to the subordinated lenders, mezz lenders, et cetera. It's also BDCs. But there's all this talk that there's all this capital being created that's going to ruin another good opportunity because too much capital has flown into it. You know, the good reality here is there was literally, I'll do this in terms of my arms, this much of a gap created by the banks leaving the market. This much of that gap has been filled by these alternative capital providers. The entire market cap of the entire BDC space is something like 40 billion. That's almost the amount of the annual amount of underwritten loans that banks participated in the middle market space. So it's getting there, but this was an unintended consequence, and hopefully as alternative capital continues to form, this will help hopefully have the positive consequence of pushing the economy along. In the meantime, it's created great businesses for firms like ours. Well, one of my personal objectives beginning almost 50 years ago was to reduce the dependency of the financial markets on just a handful of banks and financial institutions. And as you've seen over the years, there's been a substantial drop in the percentage of loans that are actually owned by banks in the United States, to where today less than 20% of loans, and the role of a bank is more of a mortgage banker underwriting research. The challenges that we've talked about and we'll get into before the panel ends today are that most other countries in the world have not experienced this, similar to the United States, where you have thousands of potential lenders. And Europe, for example, is still dominated by the banks and their lending, and most of the loans are owned by the banks if you look at Europe. So the picture is substantially different in Europe than the United States, though we have had an increase, and in many cases a dramatic increase in issuance. Madeline, before we go any farther, I think people will be very interested in what are your priorities as the treasurer of the World Bank? Okay. What is the job of the treasurer managing the money? In case we have any people when you retire that want to take that job, we'd like to start that.
Okay, you can start thinking about it. Thank you very much, Mike, for having me, and thanks for the question. So let me just give you a little bit of background about what we do and then sort of tell you about my top priorities. In Treasury, I call it we're not your grandfather's Treasury, because we do typical Treasury functions. We issue debt. This year we issued 51 and change $billion, and we manage a portfolio. But we manage about $145 billion of assets. About $22 billion is the pension for the World Bank Group, and then we manage large sums of money, not just for the World Bank, but for member countries. So coming out of some of the programs that we have in Treasury. So one of the things we do is work with central banks and sovereign wealth funds and national pension plans, sharing knowledge in terms of how to manage money in reserves in particular on the central banks. So we've got about 55 different central banks and sovereign wealth funds in our program. And it's everything from governance to investment guidelines and strategic asset allocation, building indices, building portfolios, and so on. So that's sort of one of our priorities. But the other priority that I have is to work with finance ministers and debt management offices, working with them, sharing knowledge on how to manage their debt, and finance ministers working with them in terms of managing their risk, whether it's financial risk or catastrophic risk. So one of the things that we do is work with them, helping them hedge their foreign exchange exposure, their interest rate exposure. But I think my single most exciting thing that I love to do is working on the catastrophic risk. We do a lot of catastrophic risk, working with countries managing their risk, anything from tsunamis, earthquakes, cyclones, typhoons, and so on. We did the largest ever weather and energy derivative for Uruguay. Uruguay has a utility provider that is 85% generates electricity through hydropower. And every year they seem to have a drought, and they have an ability to be able to switch into oil or gas to generate electricity. But if there's a high price of energy and if there's a drought, then they get squeezed. So a couple of years ago, they had a $450 million shortfall in their budget. So we ended up putting together and just closed this past beginning of the year a $450 million, largest ever weather and energy derivative, where given the low rainfall and high energy prices, anything that's parametrically measured, or we can have an index to trigger a payment, we can hedge. And so we help them hedge that. But now we're working on pandemic hedging. So for the Ebola, we're working on longevity risk. So to be able to, obviously a pension plan, the highest risk is people live too long. And so any kind of risk that is good contingent liability planning for these countries. So it's really quite exciting stuff.
The Institute over the last decade particularly has been focused on potential for catastrophic risk. Can you create markets, et cetera? And let's take something that has been discussed at our session today, Ebola. How would you go about analyzing that potential risk for a country, and how would they be able to hedge it? Well,
the mortality rate. So Ebola is too new of a disease and of an epidemic to be able to have statistics to measure. But what you can do is use mortality data, and some of the reinsurance companies have pretty good data. Alternatively, one structure that we're working on right now, in fact, is to say if the WHO defines an epidemic in 3 different African countries, then that would be a trigger. And so we have some investors right now that are interested in buying some of this, where it's a measurable index, and so the country would have protection to be able to offset its fiscal buffers in the event there was some emergency like that.
Thank you. John, you founded your firm in 1977. And as I and you think back over the last almost 40 years now, we've had a lot of predictions. And things generally have been clear. So today you sit there managing considerable assets, and one day a person comes and gives you a presentation on deflation, and the next day they give you a presentation on inflation. And so, or you could get them the same day, one in the morning, one in the afternoon. How do you decide how to invest in these markets with this great, divisiveness and least predictions of what's going on?
Well, one of the things as we all are trying to do, is trying to figure out how these macro events are going to affect the market. Mike, I remember very well in the early 80s talking to you and talking about capital markets, and your comment was, we don't need the blanking banks.
I'm sure I didn't use a 4-letter word.
But what we are seeing just happening here in Europe and in the U.S., an expansion of the convertible bond market. There's been more issuance in Europe than in the United States. So we are seeing that the capital markets from that point of view take hold and been expanding in here. So that to me is a positive, that the capital markets are providing funding and access to capital instead of the banks. And the inflation deflation is very critical here. I think if you would have asked me, 6 months, 8 months ago, I would have said, gee, inflation looks like it's coming back. And what's been happening lately, it seems like we're almost in a deflation type of mold, and that's a bit worrisome in here. But I think what it does for the market, it causes some near-term volatility in here until growth starts to pick up again. So we're concerned about it at this point.
It's interesting when you get this situation that we talked about, deflation, inflation. This is partly the role of investment bankers, part of the role you had played, Rich, part of the role can you structure securities that will work in either environments? And as you remember, John, beginning in 1983, we had, in the early 80s, U.S. governments yielding as much as 14, 15% long-term, short-term rates over 20%. And the bond warrant that we began to issue, one for MCI for $1 billion and others for Steve Wynn and his company, really was grappling with the fact that you could substantially reduce the interest rate by providing an equity kicker. And where the company rarely gets the premium in the option market that you see options sell for, by issuing warrants, that premium could be captured by a company, and the investor, in fact, could get an equity participation or have a debt security that was created at a discount. And so the idea was, could you actually create securities that would work both for the investor and the company? And I think this is one of the challenges, and one of the challenges for investment banking and firms today, and the people providing mezzanine financing and other financing. Can you create securities that will actually work no matter whether we have deflation or inflation for both parties? Tom, as you look at the situation, managing more than $200 billion in assets today, and some of the banking regulation today, which is limiting banks to be able to finance companies at more than 6 times leverage, and with interest rates as low as they are, if you're buying a company at 8 or 9 times EBITDA, or maybe let's call it 7 times cash flow, if I'm only paying 6 or 7% for money, obviously that private equity firm, the other part of Rich's business, wants to have more than 6. So the bank now has to ask for permission or a waiver from the Fed to do that, and in many cases they don't get it, so they're now turning to firms like yourself to see what you would do. How is that affecting your business? How has regulation affected your business today?
Well, I think that's a very specific example, and clearly the number of instances where we're seeing the banks unable to do a deal, where non-banks on a larger deal play is more than 0. It's happening in a handful of instances. The reality is it's not just those leverage limitations on larger deals that will impact banks. It's really about bringing financing down even to the smaller and medium-sized enterprises. And that's, to Rich's point, where I think other opportunity is in direct lending. The chart Mike had up a while ago, showing institutional loan issuance. We're already a non-bank market today in the U.S. Where the opportunities lie for asset managers like us is going down market, where we've been historically as mezzanine investors, but me being more full-service leverage providers to companies that are smaller than, say, 50 million EBITDA. That's part of the U.S. story. Europe, it's all happening at once. I think when you look at the impact of the stress on the banks, the need for institutional money coming in the market, and quite frankly, not unlike 1990, where you had a more diversified high-yield bond and leveraged loan, institutional leveraged loan market emerge. I think you're seeing that growth come out of Europe, and you're seeing the institutional money replace the banks, albeit slowly, maybe at first. I do think it'll go faster than the US, which took over 20 years to get to that point.
Well, they also have a roadmap to follow from that standpoint.
Yes.
So one of the questions in investing or capital markets or almost in anything that you get involved in is, are people making decisions based on facts that are incorrect? Have they made assumptions on facts that just don't exist? And one of the things I discovered many years ago is most people don't do research. So you ask a person, where did you get that information from if you want to go that far? And they said, well, someone else told it to them. And if you went around the table trying to find out, well, who actually did any research here on the facts? And so, Elroy, you've got many assignments, not the least of which you've got to teach some students about the future and all these issues. But you have another assignment that's particularly related to this panel, and that's you've got this assignment with the world's largest sovereign wealth fund and how they decide to invest their money, responsibilities for commitments for that money, and the fact that the size of $850 billion, they're not coming in and out of every market every hour of the day. And so we've had this enormous growth in liquidity in the world, one in the sovereign wealth funds, of which Norway now is the largest, but Abu Dhabi and Saudi Arabia and China, etc. So you've had this enormous creation of assets in sovereign wealth funds. Two, you've had this enormous buildup in liquidity by corporations. And I think we really don't focus on this enough. We see it a lot of times when people talk about repatriating money. But this dramatic buildup, and if you looked at just at the start of the financial crisis today, Apple's cash is increased 11-fold, from $15 billion to $164 billion. GE's cash is more than doubled. Microsoft's cash has gone from 33 or so, 23 to 88. Google, Cisco, and so on. Enormous buildup in cash. And this is just not in U.S. companies. If you take a look at corporations around the world and compare their cash today to the GDP of companies, of the country that they're located in, Japan is number one. And cash in Japan and Japanese corporations is now 44% of the entire GDP in the world. Individuals, in addition to the movement of corporations and sovereign funds, due to the volatility in financial markets, have dramatically increased the percentage of their net worth that's in cash. The United States, for example, individuals in the United States have doubled the percentage of their net worth that's in cash since 1907. Since 2007. Probably since 1907, it's probably increased 100-fold. So as people were holding 5% or so of their net worth in 2007 in cash, today in the United States they're more comfortable holding 10. And if you look at individuals who are in the upper 1% income, you find generally they're holding 20% of their net worth in cash. Individuals, sovereign funds, corporations today have exceeded levels of cash that have ever been accumulated before in history. So it makes one think there's a lot of liquidity. Elroy, what have some of your research, how is it shown and how is that reflected in you advising the world's largest sovereign fund?
Thank you for that question. Let me just start out by painting the picture as to how I got involved and set the scene for you. In 2001, the then head of Norway's fund, which was already substantial in size, came to see me because I, with two co-authors, had done quite a large volume of research on the investment performance of different asset categories over very long periods of time. He arrived with a Norwegian newspaper. His photo was on the front page, and the headline said, "We give this man," and I can't remember how many zeros there were, something like 600 million kroner. No, we give this man 400 million kroner, and he loses 600 million kroner. But it may not have been millions, it may have been billions, doesn't matter. The headlines were, we give the money to him and he wastes it. The market had collapsed over the course of 2000, and his desire then was not to hide away from financial journalists and the Norwegian public, but to help to understand what the long-term strategy was, which had been built on some of our research. And so I got drawn in from 2001 into working with this fund. The fund is now big. Looking at you, there's some grown-ups sitting in front of me. The younger segment of this room is over there. So I'll give some advice to you at the back. Some of you may be single. And if you've got a free choice, look out for a Norwegian to marry.
You know,
the average Norwegian is a millionaire, just in terms of their stake in their sovereign wealth fund.
Elroy, in the United States, we suggest look out for a Native American, okay? Because they're allowed to have their own casinos, their own land, and not to be taxed by the United States.
So these young people, they have a stake in the Norwegian government pension fund. It's called a pension fund not because it's a pension fund. It's a sovereign wealth fund. It's misnamed. It's misnamed to give a signal to Norwegians that this is not there to build highways that go from where there is nobody to somewhere else where there's nobody. It's there to signal that this money is there for the great-grandchildren of people who haven't yet met one another. It's very, very long-term money. So when I started teaching investments at London Business School, we used to think of pension funds and insurance companies as long-term investors. As the importance of interest rates that one uses to identify what liabilities are has become higher and higher, and so those institutions have become more short-term in terms of their responsiveness, it's sovereign wealth funds, along with some other groups, such as wealthy families, who are the truly long-term investors. And so the question of what the strategy that you follow ought to reflect the different characteristics that different investors have. A really long-term investor does not engage, for example, in asset liability matching. That's for those of you that represent pension funds, for example, where there's some liabilities and you need assets that match them. What Norway and many other of these funds do is something I would describe as liability asset matching. That is, they look at their block of assets. That will determine their spending in the future. They have a spending rule. And so liabilities follow from the amount of wealth that they have. That gives them some freedom, for example, to tolerate volatility over quite long periods, to be on the other side of the sentiment of investors around the world, to be buyers when people are in general wanting to sell, and to be sellers when people want to buy. It makes them natural portfolio insurers, not necessarily through an asset manager that creates portfolio insurance products, but from being on the other side of investors. So there is a focus on the long term in Norway, and there's a focus on being contra-cyclical rather than pro-cyclical, and a focus, limited of course by the fact that when you've got large sums of money coming in, there's a limit to what you can do. There's a focus on managing to take advantage of being large and long-term and not driven by liabilities. Our research shows that the margins that are available to do that are modest. So the equity risk premium, the amount by which equities give a return above riskless investment, is more modest than people thought up to the end of the 1990s. Costs are therefore, in a relative sense, more important. Trying to find other risk premia becomes more important, not just the equity risk premium, but other risk premia that are appropriate. Managing a tight ship becomes important. I think that's enough for now.
Okay, thank you. We'll come on back. One of the areas that focused on in capital markets greatly today, Madeline, is what's going to happen in China. At some point in time, China will be the world's largest economy. And if you look historically, going back to 1820, you see that India and China itself made up more than 40% of the world's economy back in the 1820s. And then a lot of things occurred. Industrial revolution continued to develop, access to capital, financial markets, etc. And so it dramatically changed. in that period of time. And the U.S. went from maybe 1.8% of the world's economy to 40% of the world's economy at the peak. And as we look at the world's economy and a number of projections of where the future is going, Madeline, you see here really a significant shift with China and India and Brazil and potentially Indonesia here as 4 of the 5 largest economies in the world. So the need for capital markets and the development. But today, in many ways, the world's been very focused on China. How do you look at China from the World Bank standpoint? What guidance could you give us in markets as you think about risk, contingent liabilities, et cetera, to financial markets?
Okay. I'm going to give you my views, not the World Bank views on China.
Of course.
I actually am...
I want to make sure we got that on film. These are Madeline's views, not the World Bank's views.
I'm a bit concerned about China, frankly. I think, they just recently printed 7.3% for the third quarter, lowest in 5 years. The question about China is it's going to be a hard landing or it's going to be a soft landing, and it has huge knock-on effects for the rest of the world. Concern is, are they going to have a GDP less than 7.5%? If so, that would be the first time since the late 90s. And this is having a big impact, obviously, as they switch from being an investment-led economy, where they have now enormous overcapacity, to a consumer service-led economy. They are certainly having some hiccups along the way. And I think we've seen, the slowdown, certainly in the commodity markets, and I think this has had a huge spill-off effect into other developing economies. So take a look at, oil, of course, is down not only because of China, but also because of the U.S., probably the shale production. But other commodity prices are off dramatically, and that has an impact on, African economies, on Asian economies, and so on, which are big markets for China. Take a look at oil prices. Oil prices right now are, in the low 80s, where the break-even for some of these countries, like Nigeria's break-even is 119. So I worry about that. So all indications were going along well with China. I think
when you say break-even, you're really talking about their budgets, not the cost of producing.
The countries, they do their budget on an annual basis, or maybe a little bit forward, and look at how much revenue do I need, what's the price of oil do I need, and therefore, how much can I spend? So for example, Russia's break-even is $96. Nigeria, as I said, is 119. Liberia is 121. So the impact that China has on all of the developing economies is going to be, has been, and is going to continue to be a significant drag. I think one of the things that China needs is reforms. And last year, there were sort of pretty good indications that they were keen to do so, but it seems that as they've gotten a little bit off track. So last year, when they talk about the Shanghai Free Trade Zone, opening up the capital markets, it's really important for them to be more open in terms of, the financial markets, certainly in terms of their exchange rate and so on. So they've kind of gone, a couple steps forward and then a couple steps backwards. So I'm a little bit concerned. You mentioned India. India also is, in my mind, very susceptible to financial flows. So I don't think if, but when the Fed starts to tighten and money starts to sort of flow out of some of these economies, India is very reliant on financing, not only external financing, but also investing in India. So I think they're rather susceptible.
So we could step back here, and one of the things that might be of interest to you would go back and study the comparison between China and the United States, where there was a large period of time where the United States was using 50% of many of the raw materials in the world being shipped in as you built out the United States, built the railroad, built other structures, and building out the continent. And so when you looked at coal or steel and many of these issues, and the fact that China was using 50% of the world's output, both what they produced internally and for importing, I think this is the area that you're addressing here. On the other hand, we have other parts of the world that have great potential for growth, and that's both in the Africa and potential in Latin America and other places of the world. And I think it is some what unrealistic to assume that anything can grow at 7% per year. And when we say that China might only grow at the unbelievably low rate of 7%, almost the entire world would love to grow at that rate. And when you look at the fastest growing economies in the world, you see in this century particularly that most of them are in sub-Saharan Africa or generally in Asia. So these growth rates, realistically, I think it's impossible to continue to project those levels of growth. In terms of India, India markets have really performed very well, Madeline, relative to China and some of the other markets this year. Tom, if I want to go back to you in terms of this uncertainty, this flight to safety, liquidity, I think both you and Rich could easily identify that with inventories of dealers falling dramatically with regulation, and the fact that the amount of dealer inventories, or quote, market maker inventories in the world dropping, one of the potential side effects of that is liquidity, and that they're not building their inventories or shrinking them and adjusting it to supply and demand in the marketplace. How do you take advantage of that from where you are at Babson, and how do you factor it into your investment decisions?
Well, clearly, if you go back to pre-crisis, dealers would make markets more readily, and bond markets in particular. And there's just less capital because of the bank's limitations or risk appetite to put against those markets. We have to look at that and assess that in buying into different bond markets, whether they're high grade or high yield, whether they're bonds or leveraged loans, for instance. I do think in the U.S., though, institutional investors such as ourselves have more access to be able to step into that liquidity fold. We're constantly in the market day in and day out, and we have a view on where we would buy a specific credit or security. So that helps balance it out, maybe not totally. If you get a lot of sellers at a point in time, I'll take the example of leveraged loan market. You may see outflows from the mutual funds, which can't just go to the street dealer and they would sit on it and then sell it out to the market later in a disciplined fashion. You're probably going to see a little more volatility on the sale as those funds try to get liquidity. The good news in the U.S. market is you do have that level of institutional appetite ready to go. You know, we have a lot of interest in those markets. In the recent backup in September, October, you know, we found a lot of examples where we were buying assets that maybe 2 months ago we thought were too rich, but traded into a zone where we were willing and had large appetite to buy. So I think there is a little bit of a shift of how proactive an institutional investor needs to be in liquidity situations, and maybe a level of less reliance on the street for providing that liquidity.
Could you compare and contrast Europe versus the United States in that regard? Since you're a major investor in both
Sure.
Western European markets and the United States.
Sure. Well, clearly the U.S. is going to have a level of liquidity, so for moments where there is a large amount of selling, you know, I think the institutional market can react more quickly, so maybe it trades off a little more. We said earlier the European market has been in a transition since the crisis to more of an institutional market. There's not as much of an impact of what I'll call the fast money in the market, or the retail money in terms of inflows and outflows that could have more of an effect in the U.S. market. So I think that counterbalances a little. That said, you know, there are times there are sellers, and you know, it's really up to the growing institutional market to take up that slack. You know, the banks really aren't a buyer. So you might see a little more volatility if there was more assets coming out. But you know, clearly we look at the fundamentals. I think one of the important things here is discerning between a technical that's or caused by maybe a spike in volatility like we've seen, and really a fundamental credit deterioration. And that's what we look at every day in our portfolios. we're fundamentally looking at each and every loan, whether it's European loan or US loan, we're following that credit. So we have a view of if we will own that. And a lot of the selling you saw recently, the global macro picture didn't change overnight. But there were geopolitical events, there were, if you will, a spike in volatility due to various fears that did change some of the technicals of the market. Those are times you can react, and I think that's what we try to do regardless of the market, whether it's US or Europe.
If we pull up slide 40 for a moment, looking at Tier 1 capital ratios, you can see for the most part the European banks have reduced their ratios substantially from what they were, but they're still relatively high in many ways compared to the US. But these ratio levels are substantially below what they were in 2007. And so the marketplace has said, well, pull up slide 20, that the European banks are substantially more leveraged than the US banks relative to the size of their economies. And so if you look at total assets relative to the GDP on slide 20, you would see that US is substantially less leveraged in a sense versus Europeans from that standpoint. And if you look, for example, at France, at the three largest banks in France, relative to the three largest banks in the United States, similar to the condition of Ireland, the three largest banks in France have a multiple of the GDP of France, where the three largest banks in the United States have a fraction. So the marketplace has been waiting for a number of years for these banks to deleverage. We recently had the stress test, which left off most of the major banks today. And so they really have not liquidated these assets. And in addition to that, to date, the value of the assets they've held have substantially appreciated. So where, as you might have been selling assets between 80 and 85 cents on the dollar, today you're looking at assets somewhere, if they sold them, between 95 and 100 cents on the dollar. So, Rich, what we've seen here is this kind of the golden age for private equity firms to raise money. I think firms such as your debt manager, today you have the ability to issue different type of funds for people to invest in. And so what type of assets are you looking for? What type of funds to buy? What type of assets in this environment? And so we've been waiting for the reduction in these assets, but it hasn't occurred today.
Right. Well, you have a good nose there, Mike, because that's exactly how we think of it. Just to carry on and maybe just bring this full circle to Tom's point, one of the biggest problems in investing as a long-only liquid market investor is, simply put, supply and demand. There's more demand than supply, and that tends to create lower yields, less covenants, covenant light, which we call this page left intentionally blank, is the norm. And finding ways to invest without being a term taker, hopefully being a term maker and getting some real yield, is the biggest challenge. And let me just turn the question around to start from that angle. And I think the biggest mistake any investor could make is just searching for yield in the wrong places. Those excesses, as Tom was talking about, when things go bad in leveraged finance. And by the way, the first lesson I ever learned almost 30 years ago when I started in leveraged finance is never talk about high yield when Mike's in the room, because you'll inevitably know less and he'll make you look dumb at some point. So with that caveat, there was very little liquidity 6-7 years ago when the market had hiccups. There's less Volcker rule, all this red cap, all the slides you just saw, there's even less today. So clearly, being a long-only investor is fraught with peril. We talked about the middle markets as a place banks aren't anymore. There's a place to disintermediate, to provide capital. Banks aren't. Interestingly, at times, 7 years post-crisis, that all the 7-year, 8-year, 9-year debt is coming due. Europe, I think where maybe we can take this question seems like that opportunity, like going into a time machine back 5 years ago in the US. You saw the slides. The banks are the lenders. It's not the alternative capital providers. So I think the thesis is it comes from two places. It comes from, one, assets coming off banks' balance sheets. The second place it comes from is banks, again, I keep using the word, but being disintermediated and alternative capital providers providing that capital directly, particularly for the smaller companies. Unfortunately, in both of these theses, this is played out. There are opportunities in Europe. It tends to be more around sponsored deals. But these direct lending opportunities are few and far between only because of the nationalistic sort of fervor around lending in each of these countries. My bank, Deutsche Bank, for example, the Mittelstand, this is sort of the raison d'etre of some of these banks and sort of how they think about the world. And we couldn't possibly compete with the I would almost say subsidized lending. And as far as getting assets off banks' balance sheets, we used to kid that there was a thing, there's rule for those of you familiar, IAS 39 or impairment-based accounting on banks. Well, when banks didn't have enough capital and they were forced to sort of contort into all these capital tests that the regulators are putting upon them, the last thing in the world you'd want to do is take an asset in a book that you didn't have to mark down because it's impairment-based. For example, if you're the only lender, how could there be impairment? Just keep extending. So this is the last place that, and my thesis has always been, as time goes by, as banks build up equity capital, they start to, pass their stress tests. Maybe this is a seminal moment. I don't know. You'll start to see some of these assets come out. I think the reality is they come out. The real answer is they come out when they get to par. And when they get to par, it's all of a sudden, who cares? It's not that interesting for us anymore. The whole thesis was buying stuff at 60 cents on the dollar.
But, Mike, can I make a point?
Sure, go ahead.
But that graph that you just showed, or that chart, is precisely one of the reasons that Europe is in the quandary that it's in terms of the macroeconomic problem, right? Because banks, of course, are 80% of the market is where the companies get their credit in Europe, 80%. You alluded to it before, and of course in the U.S. it's the opposite. It's the capital markets. And the fact that banks are so long, if you will, assets, and because of all these, the Basel III and everything else, net stable funding ratio, this is why banks aren't lending. This is why economy is not turning around, especially in, for example, Spain and Italy, where you had the SMEs, and this is why they're not doing infrastructure financing. So that's a huge fundamental problem. That's the bottleneck in economic growth.
I think, let me just summarize the number of points that have been made here to put on the table. One, there's an enormous opportunity in Europe and other parts of the world for people that want to engage in capital markets, become intermediaries, figure out different ways to finance businesses today, to reduce the dependence of banks on the system. That the growth of a particular economy, let's take China for example, there's enormous pressure on both the government and the government banking institutions, who at this time have really not served the small and medium companies in China with most of the loans. So 88% of the number of companies would be what we might call small, and 99% of the companies in China would be small or medium. The number of employees, let's call it 90% or 85 to 90% are in small and medium companies. Yet most of the money is still going to large enterprises. And companies, small and medium companies in China are still turning to the United States to finance. Who's going to create those capital markets in China to give them an opportunity to grow? Which institutions are going to do that to kind of de-risk that system? Who's going to create those capital markets in Latin America? Who's going to create those markets in the Middle East? Who's going to create those markets in Africa to allow these organizations to grow? And so those are some of the challenges that are in front of us today. John, let's take a look at some charts. Central banks' targeted interest rates, slide 41. So you're sitting there in Chicago deciding how to invest today in capital markets. And you notice they used to be substantially higher. We didn't take them back to periods of time, 1980, 81, because they would have gone off the chart on the high end. But you're looking at that issue. You're looking at real short-term interest rates. And you notice, for example, as you look at them around the world today, slide 42, that in fact, in many cases, they've been negative. So real interest rates are negative, which makes you believe, unless you believe in deflation, you wouldn't want to invest there. And then you look at, say, if we took the U.S. 10-year Treasury. And it's very interesting to see that the U.S. Treasuries yield almost 100% more than you have in Germany, substantially more than France, 4 times as much or 5 times as much as Japan, and on a day-to-day basis, often less than Spain today. So you're looking at all these charts, and then you look at the size of the central bank's holdings, and you see that they've increased a lot. And now you've arrived at work, and it's Thursday morning. What are you thinking about?
Well, I think...
How are you going to protect the investors if rates go up?
I think one of the things is, from an asset allocation point of view, you're much better in the equity markets than you are the bond markets. And, you know, we could look out, and now it looks like rates won't go up until, you know, late next year. But the one thing you'll learn over time is that when those events happen, even though people are predicting the increase in rates, when it happens, it's going to be a big surprise. And you got to get prepared before the event, not after the event. So there's no yield. So, you know, you might as well sit in cash.
Now, weren't you a convertible bond manager when you started? Didn't we discuss downside protection? Now you're telling us we should be invested in equities.
Well,
where have we gone?
Well, equity-like securities are convertibles. So there you're getting some yield. And what may happen here is much more volatile markets over the near term. And so obviously convertibles can cushion that volatility in those markets. That's been the history. So that's been very positive. And what we're seeing today is a lot of pension funds and other investors that primarily look at the fixed income side of their asset allocation, actually using convertibles as part of the fixed income side of their asset allocation. And we agree with that. That's because there's been like 10 times interest rates have gone up, and the convertible market has beaten that market 9 out of the 10 times. So, you know, that's where we stand.
So that's how you sleep at night. John, if we gave you money to manage, knowing you're going to beat the market 9 out of 10 times.
Well, I want to manage some of the Norway pension funds because I like a 2-generation long-term view. I've never heard that before. 2 generations. I'll see you in 2 generations.
No, it's more than 2.
More than 2
It's the successive generations of people who haven't yet met. That's what I said. That maybe they haven't yet been born, and that's why they couldn't read each other.
I have a new definition of long-term now.
And I think if you take a look at private equity today and just the dramatic increase in their liquidity, their potential buying power, slide 61, their size of their assets here, just waiting for valuations to change so that they can come into the marketplace today. And obviously the inverse of these multiples, pre-tax multiples, these yields that companies are selling at are substantially higher than even the high yield market today. So this once again, Elroy, brings us back to you. Okay, we are all anticipating, what is all this research of yours showing? What have you learned that we should reflect in how we construct our portfolios in capital markets? Can you share that with us?
Let me share it with you. Let me set the scene. When I started teaching investments, we used to have a graph. It was the way we explained the capital asset pricing model. We'd have a horizontal line which represented an interest rate you'd receive over time. That was the reward that you got for withholding using your cash. So it's the time value of money. And then what we'd have is an upward sloping line which showed you what expected returns were. And as risk got to be larger, expected returns got to be bigger. The world we're in now is that interest rate in real terms is 0. And so if you want a reward that's there for the long term, it can only come about from exposure to some sort of risk. Your way of doing that is embedded equity risk, but it's likely to be equity-like and maybe explicit equity risk. Let me show you a little bit about the long-term performance of markets. And I'm just, first of all, going to pick on slide 4. just with one click. No. Can you back up? Just one click. That's it. One of the things which has interested us is what the performance has been of developed markets and of emerging markets. When you talk to emerging markets people, they will show you recent charts. We can show you one later if you want. But you've probably seen them before. They look quite good over the recent past, over this century. And people will look you in the eye and say confidently, emerging markets will do well. We wanted to go back to look at the very long term. All of our research just about starts in 1900. And we have data for 23 different markets in 1900. The sample of markets which we have stock, bonds, bills, inflation, exchange rate data expands to 85 countries in the last couple of decades. And so what we wanted to do is to go back and reconstruct what developed markets and developing markets might look like in a period before anyone used the words emerging or the words developing. And so what we did was we looked at the index providers who produce estimates of the performance of developing or emerging markets and looked at their criteria. The criteria usually, if you look at Russell, FTSE, MSCI, usually involve something like 20 different characteristics. If you threw away all but one of them and you looked at GDP per capita today, if it's above 25,000 US dollars per person, that will be a developed market for all of the index providers. And if it's below 25,000, it will be an emerging market. And that will correctly classify now or in recent years what the classifications look like with only four exceptions. Four exceptions are 3 Gulf oil states, small states where the measure per capita is tricky, and one European market, it's Portugal. So what we did was we took the 25,000 US dollars and we took that back in time, adjusting for inflation, and used that as a cutoff to identify. Can we just stick on the, no clicking, just stick on that left-hand bar chart, please?
Well, we're just going to stay on that
Can
right
we
now.
just stay there? So what we did was we took these markets and we identified when they were above or below 25,000 US dollars adjusted for inflation. We start with 23 markets at the beginning of 1900. The first emerging market on that criterion to become developed was Finland. It took 3 decades to get there. Waited a little bit longer, and by the middle of the 20th century, Chile is moving in the other direction. That's all. A little bit longer, and Japan is recovering from the Second World War, going through its wonder expansion. We have Spain also becoming a developed market marked in blue. Then Argentina in the mid-1970s falls below developed market status and becomes an emerging market, part of its downward trajectory in investment terms. One country has been promoted and demoted. That's Greece. That's the one with blue for a promotion and red for a demotion. And so what we have is out of between 23 and 85 countries, multiplied by 114 years, we have just a handful, just a tiny handful of promotions and demotions. So we've taken that, used this data to go to the individual country series that we have to construct an emerging market series and a developed market series. Now let's have one more click. Here you can see in blue the performance of developed markets, and in red the performance of emerging markets, defined the way that I've explained. Emerging markets did worse than developed markets over the long term. If you start in the middle of the 20th century, they did a little bit better. The big fall was in the 1940s. In the 1940s, Japan fell in real terms by 96%. China fell by 100% by the time we've moved from the early 1940s to the end of the 1940s. And so if we now move with that strap line there, emerging market performance was about 1.5% higher if you start in 1950. It was behind if you start in 1900. It's clear that the confident belief that economic growth in emerging markets will give you superior performance, that depends actually on the period that you look at. There have been good decades and there have been poor decades.
Well, let's just stop here for a moment if I could. So there's something that happened in the 1940s called World War II.
Yep.
Okay, and obviously Japan invasion of China and other challenges fairly well decimated the economy, as you pointed out. But you know, and your findings are that the developed economies did better than the emerging economies over a long period of time.
Yes.
Over a 100-year period or 120. Not every investor, however, can really focus that long, and some people might only have a 20-year horizon. I'm sure some people might have a 5-year horizon. So if we took out World War II, what you've told us here that emerging markets have substantially outperformed developed markets since 1950 from that standpoint.
No, that's roughly neutral performance. The beta of emerging markets relative to the world is around about 1.3. So if you had a very simple capital asset pricing model, business school teachers' view of this, neutral performance would be a reward of something of about 1.25%, 1.5% just for their higher beta. Sometimes they do well and sometimes they do badly. But if you're taking a view for the future, the question is, might there be an outcome which we currently write off? Remember that the Goldman Sachs BRICS story was not entitled a projection, it was a dream. That's how it was expressed. If that dream comes true, then there's a country which will do very well. But can we be absolutely confident that a Tiananmen Square and unpleasant consequences will not happen? That was unlikely before it occurred, and then it occurred, and then there was a recovery afterwards. So my take on this is that one has to be quite cautious about forming optimistic views about one segment of the world compared to others, and that it makes sense to diversify across these countries and to be more of a global investor. I can see a shaking head here, so unless you're Polish.
I think we're forgetting just one really quick point, the growth of the middle class around the world. You're talking about a commodity-based index versus consumerism. And we're seeing consumerism all over the world. And it is in emerging markets. I think they're here. You know, they're not emerging anymore. They're here. The growth of the middle class around the world, and we have a global world, however we like that, one way or the other. So as investors, we're looking for opportunities in the growth of the middle class around the world. And I think just categorizing them that way, we miss those opportunities.
But John, I don't disagree with you. If things are here and we know about them, and we've now shared them with up to 800 delegates at the Milken Institute, they'll be in prices by tomorrow morning. In fact, people may have realized this earlier. So things that are here are not opportunities. It's things where we've had insight that isn't shared by everyone that offer profit opportunities.
I think the other element, I think we all know that a lot of people refer to regression analysis, which has some basis that the future is going to be like the past. And so if we look that way and thought about it, well, over a period of 4 million years, life expectancy increased by 11 years. So at the first, and looking back, 4 million years, life expectancy increased by 11 years. So I wouldn't expect a lot of consumer growth, a lot of extension, etc. Then, whoa, something happened. In the last 114 or so years, life expectancy, 12 years, has gone up by more than 30 years. So something happened. And I think, John, the something happened is also technology. That we cannot assume the past will be like the future when Africa has gone from 2% penetration of mobile to 84% in essentially 1 decade. We're seeing this, or a little more than a decade. And so the question is, and I think, Elroy, you've really put the issue on the table, will the future be like the past in the long run? And are we adjusting for risk appropriately? And when you see some of the work you've done, which is fascinating, selecting markets based on dividend yield. I think your results, slide 8, were quite fascinating to look at here. There's a bias towards high dividend yields in the sense of performance. What I was trying to understand was that period of time where actually the ones that had higher yields did poorly.
It's an intriguing chart. Can you take one click off? I just want to concentrate on the bit at the left. And one more click off, that's it. We've got a very enthusiastic clicker at the end. I'll probably get into trouble for saying that. One of the features of many assets is that carry is rewarded. And so whether you look at commodities or currencies or the sorts of fixed income securities you've been hearing about, high income has been rewarded in a way which exceeds anything that you learnt in business school about the irrelevance of income, the irrelevance of dividends and so forth. It's been persistently rewarded. And so one of the questions we asked ourselves is, would this be true if we looked at dividends? Within national markets, it's already widely known that value stocks and high-yielding stocks outperform growth stocks and outperform low-yielding stocks. What about across markets? So what we did was we took the countries for which we have a complete history from starting in 1900. Now it's 23 markets. At the time we did this, it was 20 markets. We divide them into quintiles. Every new year, what we do is for portfolio 1, we buy the lowest yielding indexes. We buy 4 of them equally weighted. For portfolio 2, the next 4, the middle group contains 4, up to the group marked in blue. If there was no impact from buying into stock markets where dividend yields are high, you would expect the annualized performance of these imaginary mutual funds, where these mutual funds are rebalanced each year so that they can be quite different in composition as you go through time, you'd expect them to be similar, but they're not. The low-yield portfolios, which are marked here in red, have greatly underperformed the average and even more greatly underperformed chasing after income. So this is very similar across countries to what you see within countries. One of the things which occurred to us is maybe this is a product of what happened in the interwar years or in some other sort of particular time periods. So now one click. That's it. So then we looked at the same thing in the first quarter of the last century, the next quarter, the quarter after that, or the quarter that we're going through now. And in each period, it looks as though a strategy in which you chase the stock markets with high yield has been rewarded with superior total returns. So our interpretation of this is that it's a value story across markets. Countries that are experiencing trauma are ones where the stock market sells at a high dividend yield. Prices have fallen. Prices are what determine dividend yields, not dividends in the main. And so countries that are traumatized are countries which may cause you some sleepless nights. After you buy into the Iraqi stock market a few years back, or the German stock market at the end of the 1940s, you wouldn't feel very comfortable going into clients and saying, this is what we've bought for you. But in the end, buying countries in difficulty has been rewarded. And we find the same is true. And I don't want another slide on. You can put the strap line there, but no more slides.
Why don't you comment now?
I was going to ask you, are these risk-adjusted returns, or are these just absolute returns?
If you adjust for volatility, that does not change the ranking at all. The reason being that these higher yield securities are relatively higher yield countries are relatively uncorrelated, and the risks of these 5 imaginary portfolios perform much the same. It's in common currency.
It'd be very interesting if we looked at this period, and once again, as we know, it's a question of when you start and when you end. If we looked at this period of 2000, which was the crash of the internet, etc., versus picking a different point in time to start. It'd be very interesting to see, because it's hard to believe that anyone has outperformed those technology companies whose stocks are up 1,000-fold in this period of time. So by taking this period, starting in 2000, we're really picking up the crash of the previous period. But I think if we look at this as interesting, Tom, in closing here, if we pulled up slide, for example, 12, and looked at rates of return here that you've put forth, could you discuss that chart with us, which would be another one to look at here? Yeah,
on this chart, you're looking at the risk-adjusted returns between On the right side, the S&P 500 and the Euro Stock 600 or 800, and the Barclays U.S. Corporate High Yield, the CSFB Leveraged Loan Index, and the Merrill Lynch European High Yield Index. I think the point is, in this period of time, clearly on a risk-adjusted basis, if you were along the market, the bond markets, you fared pretty well. I think at the end of the day, we can't always pick exactly what's going to happen. We got to invest through cycles. And I don't disagree with you, John, that at some point rates are going up, but we can't sit in cash today waiting for the event and then redeploying into bond markets. If you look at asset allocation of institutional investors, whether insurance companies or pension funds or what have you, there's some balance of diversification between equity and debt markets you have to play. What I think is interesting is the alternative markets and the higher yielding markets, which can give you a little balance. High yield's going to react differently than a high-grade bond market to a spike in rates, clearly. So it's how you balance that portfolio relative to what your outcome is, or relative to what your liability is. I envy you, and you can flip it around and dictate your liabilities. That means you have the perfect hedge at the end of the day. But you know, we have to think about this way. I'll close on this. Asset allocation diversity is key to running long-only money in the institutional market. Clearly, there are more markets or access, whether it's direct lending or emerging markets in Asia, where we can use the same tools, loans, bonds, et cetera, to access a risk premium. That's where I think the asset management industry and the industry is evolving very quickly. You know, we need to be able to find those opportunities and develop those markets. And with technology, those markets are going to develop faster.
So in conclusion, I'd like to just maybe make a couple points. One, there's dramatic changes in the world that have occurred. If we pull up slide 73 and just look at that slide, in 1950, after World War II, prior to the Korean War, the U.S. stock markets made up 59% of stock markets in the world. Japan was down to 9% of the world stock markets. Combined, U.S. and Japan were 68%. Taking a look almost 40 years later, Japan's stock market made up 40% of the world stock market, U.S. down to 29%. Combined, they made up 69%. So you can say, you know, I didn't really change much. I owned Japan and the U.S., and they made up 68%. And then if we take a look at 2014 today, Japan makes up 7% of the world stock markets. And you can say, well, I really didn't miss much in the last 65 years. In 1950, it made up 9%. Today, they made up 7%. And the U.S. today, you know, makes up 36% of the world market. So they're down to 43. There's a dramatic change going on, and you can see that in that other column. It's gone from 6 to 35%. In slide 79, you can see something else that's changing dramatically, and that is, where is the world's economy? 80% used to be in U.S., Japan, and Europe. Now the majority is not in U.S., Japan, and Europe today, and probably continuing. And when you step back and look at something that John emotionally reminded us, is this growth in the middle class. It is now estimated there'll be more people in the middle class in Africa than live in the United States, okay, within 5 to 10 years. More people in the middle class in sub-Saharan Africa than live in the United States. And so when you look at this enormous growth in the middle class in Asian countries, you have to step back and think about what could be done. And if you look at long-term projections, you can see that most of the people in the middle class will be living in Asia, particularly involved with, if we go to slide 82, with their commitment to education and allocation of education. So in closing today, I really want to stress, what are capital markets for? They would allow you to grow. They're allowed capital flow to those things that will solve the problems of society. and create opportunities for entrepreneurs wherever they are in the world. I think as the panel showed you today, there's a lot of challenges in some parts of the world. And can capital markets do more? I'd like to, in closing, just give you one example, SO2. And so here in the United States, we had a major problem in asset rain. And so if you looked at a picture of the United States in 1980s, late 1980s, you can see this large part, particularly of the northeastern part of the United States. There was a series of movies, and most of the people in the United States were going to die in 10 years from acid rain. New securities were created, a new market where credits, if you reduced your emissions of SO2, you got credits. And if you couldn't, you had to buy credits. And that secondary market resulted in great incentives to reduce your SO2 output, just a simple financial market rewarding those that did it. And if you took a look at the map of the United States 15 years later, you can see this issue has pretty much gone away. There are no movies. There's very few articles written again. And this really symbolizes the potential for capital markets, bringing capital to growth areas of the world, bringing capital for new ideas, bringing capital to entrepreneurs so they can create new businesses, a whole new generation of entrepreneurs that will make the world better and result in higher returns for our investors. So I want to thank our panelists today, Tom, Elroy, John, Madeline, and Rich for joining us, and we look forward to seeing you at the reception later today.
Thank you for a great close to a great event. Please join us on the 31st level for our reception. And again, thank you, and we'll see you in Los Angeles, perhaps in April, and perhaps here in London next October. Thank you.